Well, as we thought it might, the sell-off in stocks that started last week has continued. The tech-heavy Nasdaq is down 9%, and the high flyers are down a lot more. Apple's down 17%, and Tesla's down nearly 30%. So was last week the top? Are we headed down, perhaps much further down, from here? Well, we asked that exact question to this week's expert guest, Lance Roberts, and you're definitely going to want to hear what he had to say, especially about the increasing additional uncertainty that the November U.S. presidential elections are adding into the mix now. Oh, and as always, please take a second to click on the like button below to help us continue the streak of amazing guest experts that we've had on the program here. The more likes these videos get, the more big names we're able to attract. And now, let's get started watching this week's market update featuring Lance Roberts. Hi, everybody. Adam Taggart, co-founder of Peak Prosperity here, welcoming you back to another week of making sense of these markets. Well, you'll see from my surroundings here that I'm not in my normal home office. I'm actually up in Idaho this week. My wife and I decided that we would leave the heat, the fires, and the smoke and come up to Idaho and celebrate our 20th anniversary, which is where we've got married. So we've been hiking mountains. We've been mountain biking out to beautiful meadows. It's been absolutely wonderful. But in that time, the markets have continued the correction that started last week. So when we were on the video last week, it was Thursday, we had seen our first down day in what seemed like forever. And the big question was this just going to be a blip or is this the beginning of something larger? Well, the markets followed through on Friday and then again on Tuesday after the Labor Day weekend. They were up a little bit yesterday, but they seem to be down again fairly substantially today. So this does seem to actually be gaining some momentum. And I can't think of anybody better to discuss where the markets are headed next than Lance Roberts. Lance is joining us from Texas. Lance, thanks so much for joining us today. As a bit of introduction, Lance is a 25-year veteran of the financial industry. He's done everything from private banking to venture capital to investment management. He is the chief editor of Real Investment Report and chief strategist for RIA Advisors. He appears on CNBC, Bloomberg. I'm sure you've seen him on television, and you've most likely read his work in publications like the Wall Street Journal, Reuters, and of course, those of you who read Zero Hedge see Lance's information there a lot. So Lance, Thank you so much for joining us today, buddy.
Hey, it's always my pleasure to be here. Thanks for having me.
You're welcome. And as always, we're joined by John Lodra and Mike Preston, the lead partners for New Harbor Financial, the financial advisory firm officially endorsed by peakprosperity.com. Hey, John. Hey, Mike.
Hey, Adam. Nice to be back.
All right.
Hello, Adam. Hello, Lance. How you doing?
Very well.
Let's dive right in here. I'm going to pull up a chart, one that I showed last week from our friend Sven Henrik, who was on the program a few weeks ago, a great technical analyst. This was a chart of the S&P showing this multi-year trading wedge that the S&P is in and how it is now, was as of last week, at the uppermost resistance level and threatening to punch through. And so it was a big question was it going to break this trend, break upwards through it, or would this trend prove as resistance as it has historically, and would a market sell-off be imminent? Well, I'm going to put up this next chart, which shows that indeed that multi-year resistance held, and the markets have corrected a bit as we've seen. They bounced off of a short-term resistance channel here. That was the bounce that we saw yesterday. Interestingly, with today's action, they've now come back down to that line and that near-term channel and are threatening to punch below it. And if they do, that suggests technically that dramatically more downside action could be in the cards. But anyways, since last week's highs, after months and months of the market running up after the month of August, where there were virtually almost no down days, since the highs last week, the S&P is down about 6.5%. The Nasdaq is down about 9.1%. And what's notable to note about the Nasdaq is that the big stocks that have been driving the action in big tech are down a lot more. Tesla's down, I think, somewhere like around 30% now from its highs last week. Apple down like around 17%. So, we're finally beginning to see some of the things that we've been warning about for weeks and months here on the program, that those people who thought it was completely different and that stocks were never, ever going to go down again and tech was going to rescue us all, are, warnings of exercising some caution now seem like they actually might have been prudent. So with all that said, Lance, let's hand you the football here. Have we just witnessed a blow off top? And if we have, how much further might things fall from here? And if we haven't, what would the further upside be in your estimation?
Well, so a couple of things that, in your intro, you hit on a lot of really key points and that people really need to be aware of. So first of all, this pattern that Sven Heinrich was talking about is called a megaphone pattern. And this is a very important chart historically because it's a chart that shows rising highs but lower lows. And as it spreads and it gets broader and broader, this is typical of what we see in what we call a topping pattern. Now, topping patterns are something that don't happen overnight and they don't happen in a short term. And so when they don't happen immediately, everybody discounts it and says, oh, this time is different. But these are very important patterns that have happened previously. The last time we saw this similar type of pattern was, guess when? 2007, 2008. Saw a very similar pattern occurring back then. So, but these things take so long to play out that everybody dismisses them. It's like valuations, right? We talk about valuations on stocks. Stocks are trading at 31 times valuations. Oh, who cares? Valuations don't matter. They do matter. Valuations tell you everything you need to know about forward returns and what you're going to make on your money over time. But because we have an immediacy issue in markets, we need to know what we're going to make today, right? It's all about how much money I can make. We discount these things that are very important to long-term returns and especially for portfolios over time. The other thing that you brought up that was also, so that's one thing, right? So, is this correction that we're talking about right now, is this different? Is it the short term? Is it long term? The answer is we don't know yet. We did run in exactly to the top of that uptrend line that Sven was talking about. We did fail at that level. And we are now testing key support. So on Tuesday, a lot of major stocks and indices tested the 50-day moving average. We broke for the 20-day moving average, tested the 50-day on Tuesday. On Wednesday, we rallied directly to the 20-day moving average. Now, this is a little bit technical analysis 101, but the 20-day moving average is a very short-term moving average that really represents the short-term trend of the market. What have prices been doing over the last really month of trading? So it's a very short-term analysis. And what this shows is really kind of where buyers and sellers are lining up on a very short-term basis. That trend is very positive. But yesterday, the markets failed at that level, sold off a little bit into the close, and today have fell back down, and we're retesting the lows that we saw back on Tuesday. So this is now critical support where markets are sitting going into Friday's close. The big measure here to watch is the 50-day moving average. If we break the 50-day moving average, the next test is the 200-day moving average, which is about another 5% lower. Now, over the course of the last 3 weeks, we've been warning about in our newsletter at realinvestmentadvice.com. We publish a weekly newsletter, publish every week a newsletter really talking about where we are in terms of market dynamics and how we're currently positioning portfolios. Well, over the last 2 weeks, we've been warning about winter is coming, right? Winter is coming, and why is that? And we related this back to how portfolio management's a lot like gardening. During the spring, you plant your seeds, you till your soil, you fertilize, and you grow your plants. And when they are full of bounty, right, the one thing that traders never do and investors never do in the markets is when things are going up, they never harvest, right? They never collect some of their profits. They never reduce that. They don't go pull the weeds out of their garden, which, if you don't pull weeds in a garden, eventually the weeds will take the garden completely over, right? I mean, you won't have a garden anymore. So, portfolio management's very much the same way. So over the last couple of weeks, we were talking about taking profits, rebalancing risk, adding value to portfolios as a hedge against a market drawdown. And that's been very prudent advice to this point. And we talked about it, we said, look, this correction could be 5 to 10%. Completely normal within a market run. When you're in a bull market, a 5 to 10% correction in any given year is absolutely normal. And of course, everybody's like, nah, that's never happened. You're being bearish. And of course, everybody assumes when you say anything bearish, you're all in cash. That's not the case at all, but we were just being prudent about the risk. Well, here we are. And one key thing we said is that a 5 to 10% correction is going to feel a whole lot more. It's going to feel a whole lot worse, actually, than it is, because we haven't seen a correction really of any magnitude since March, right? Everybody's forgotten what March felt like, and we had people calling us panicking, wanting to throw everything out the window. And again, this is what you saw over the last couple of days. You had this basically a 10% correction in the Nasdaq, and people are freaking out now. Is this the next big major correction? Is the bear market back? Are we about to retest lows? Those are all big concerns. So to your specific question about is it over and what happens next? As I said, nobody knows. My best guess, though, is that typically September and October of election years tend to be a bit more volatile than normal years. And I think especially that plays the case this year with the upcoming election. There's potential for all kinds of things to happen. We've got a lot of social unrest already. That could be magnified depending on the outcome of the election. Would not surprise me to see investors kind of hedging, professional investors, hedging here a bit to offset any of that potential risk. Unfortunately, retail investors, even with this correction, they were already buying call options out the wazoo at this point. And we have a record level of call option buying. Believe it or not, they even got more speculative during the sell-off. There's like, this is, Tesla's down 30%. Great, it's a buying opportunity. Let's buy call options for 2 weeks, for a bounce. We've seen this before, Adam, back in 1999, 2000. There's a lot of similarities in terms of the speculative excess of the market then versus today. And we have a lot of similarities from that. So the risk is for sure to the downside. Doesn't mean we can't get an upside advance here and potentially retest the previous highs that we saw the last couple of weeks. But I think that's a lower probability event, at least over the next 2 to 3 weeks.
All right. Great answer. I loved your analogy of gardening for portfolio management. And too few people do that until it's too late. All right. So a little bit of an unfair question because nobody knows what's going to happen next. And I realize that. But you've mentioned a couple of times in your answer there about valuations, being at historically extremely high levels of valuation or maybe even overvaluation. You have, in a recent piece of writing, you have described the markets as, quote, engulfed by a palpable feeling of exuberance, which does sound real similar to what things were like back in 99 and 2000, like you said. So again, asking you to speculate here, we're peering into your crystal ball as best you can. One of the debates that we've been having on this program for the past couple of months is, are we in, a new bull market? Has the Fed been able to basically, get the markets back on track in a sustainable fashion? Or are we in kind of just a very large bear market rally? And given the levels of current valuation, given some of the uncertainty out there, particularly as you mentioned, both with social unrest and with the elections, which are things that we have not had in the markets too much of late. Do you have a strong opinion one way or the other on that question of bull market versus bear market rally?
Well, I think you need a better definition. And I've actually written some articles on this. I wrote a piece called The Macro View a couple of weeks ago talking about bull markets versus bear markets. And we have this rather arbitrary definition of a bear market, which says if markets decline 20%, it's a bear market. Now, normally, historically, going back through history, a 20% decline did a couple of things. First of all, when you were down 20%, you broke the previous bullish trend of the market. In other words, the generally rising trend of prices was broken, and you actually trended negatively for a period of time during that correction. The other thing that you did during those 20% declines is you reduced valuations to some degree. So when I went back and did some research about looking back through history, previous bear markets, I've been writing over the last couple of weeks that March was just a correction within an ongoing bull market. And let me explain to you why before everybody jumps off the cliff and says, no, it's a bear market. Just hold on a second. Let me explain. The first thing is that what I wrote was I said, and I actually wrote this back in April. I said, look, if the market immediately recovers to new highs It was a correction, not a bear market. Because following bear markets, you don't immediately go right back to new highs within a couple of months. We've gone back to new highs within 3 months. The other thing that you do during bear markets versus corrections, in corrections, you don't reverse valuations. You don't have a valuation reversion to any great degree. In a bear market, you do. So in the correction in March, we didn't revert valuations very much, and we're already back to basically 31 times earnings and valuations. So another indicator is that you have not gone through a bear market process because of that. The third reason, there's actually 4 reasons, but number 3 is that we never broke the long-term bullish trend. If you go back and draw a trend line on a logarithmic chart of the S&P and connect the bottoms going all the way back on a monthly basis. So when we clipped it, we did clip that bullish trend line back in March, but immediately recovered it in April. So it was not a confirmed break of the bullish trend. So we've actually never even broken the bullish trend of the market. The market prices have been rising in a pretty defined pattern over the course of the last 12 years. And if you even look at something more simplistic like a 400-week moving average, a 200-week moving average, a 4-year moving average, it lines up directly with the bottoms, right? You have this nice rising trend of prices. Okay, that's number 3. Number 4, what was that one? Number 4 is the most interesting one, margin debt. We've talked about margin debt in the past, you and I, talking about how it's like a tanker of gasoline, and at some point you're going to ignite that problem. Well, we did have a correction in margin debt to a degree, but the one thing that we never did, and you'll see this in corrections, you'll see a reduction in margin debt when you have a market correction. But in a bear market, you go from actual negative cash balances back to positive cash balances because all the margin debt is liquidated. Over the last couple of months, margin debt has almost soared back to all-time highs. So we never reduced the speculation. We never reduced the valuation issue. We never reduced the sentiment of the market. I mean, people just couldn't get back in fast enough. They've already and forgot about the correction. And again, you never broke that long-term trend of rising prices. So my contention here is that we're still in a bull market. We had a correction. We haven't resolved that issue. And I'm actually posting a piece for Monday talking about the 5 reasons why the market event is still going to come, because we haven't been through that correctional process yet. We still have to go through a debt reversion. We've got corporate debt now back to all-time highs. We've got federal debt at all-time highs. We've got a $4 trillion deficit. You know, those are all things that are going to basically come back. You've got margin debt creeping back up on all-time highs. You still have that tanker full of gasoline waiting on a match that will eventually cause that market mean reverting event that will provide us all some great investing opportunities down the road. But you don't see the type of speculation you're seeing now coming out of a bear market. And you know this as well as anybody else. When you came out of the bear market in 2000 or in 2009, the last thing you could get people to do was invest in stocks.
Yeah.
After March, people couldn't get back. I had people calling me in my office, should I buy more Tesla? I mean, come on. I mean, this is, that's not the kind of attitude you see.
All right. So Lance, would it be fair to sort of summarize what you just said there as if you thought that the market correction in March was bad, you ain't seen nothing yet?
Pretty much.
Okay. Okay.
I mean, and it's going to be drug out over years, not a month.
Yeah.
Right.
Well, elaborate on that a little bit, because we get one of the reasons I'm sort of poking at this is every week in the comment section of these videos, we get a small but vocal minority that says, hey guys, you just don't get it, right? Every week you're kind of warning us about the risks in the market, but the market just goes higher week after week after week. I've been long since March. I've made a ton of money. And in one sense, well, they're correct. The market has powered higher, right? It's been for a whole bunch of reasons that, you've written about, we've written about, not too many of them fundamental, a lot of them, dependent upon intervention and, liquidity floods and all that type of stuff and rampant speculation. But I think it's a fair question to say, hey, as long as the markets have been going up, are you guys wrong? And so you, like us, I think, are there, waving the flag of prudence and saying, hey, look, there's a bunch of really structural deficiencies that at some point are going to matter. And when that correction happens, or it might be more than a correction, it might be a full-blown crash, who knows? But it's going to be a big event, and it's going to catch a lot of the people that have gotten lulled into the Fed put mentality of don't worry, markets always go up, Fed's always got your back. Those people are going to be really unpleasantly surprised. Now, we don't know exactly when that's going to happen. So until it does, we're going to be the people out there, sort of looking like we're wrong until we're proven right. But if I could ask you this, what would you say to those sort of perma bulls that say, guys, it is different this time? Fed threw in $3 trillion. If they need to throw in $3 trillion more, they will. The other central banks are doing the same thing. You just don't understand that the world has changed. Where would you point at the weakest point in the bull argument right now?
Well, so a couple of very important things. And one is that this is, again, Adam, you and I are kind of in the same boat, is that, what I write is about explaining the risk to my customers as a portfolio manager. So, what we publish on our website is our research. That's how we're researching markets and investments and these type of things. We write about, why value stocks are important and these type of things. What people assume is that as soon as I write something bearish, that means I'm all in cash, I'm short the entire market, and I'm stocking up on gold and bullets, right? That's not the case at all. We're nearly fully invested, and we've been invested in the markets. We wrote an article back in February where we reduced a lot of our risk because we were concerned about the markets at that point. We got reallocated to the markets in April and May. Just recently, we started writing again, hey, we're taking some risk off the table. We've made some good money here, don't want to give it all back. Going back to the theory about gardening, right, as we talked about earlier. But this is the problem with this whole perma-bear, perma-bull argument. And the thing is that really there is no such things as bulls and bears. You're either long biased or you're not, and you focus on risk. That's not really bullish or bearish. It's just, and as a portfolio manager, my job's not to be one or the other. My job's to make money for my clients and not lose their capital. It's great to make money. They really hate losing a lot of money. And then trying to get back to even is not an investment strategy that works for anybody, anywhere, anytime. So that's kind of really the view here. And again, when we start looking at this idea of, the Fed, I did a study here just recently, and I looked at every Fed intervention, right? So QE1, QE2, QE3, QE4, and what we're doing now. And here's the interesting story about this. This isn't new, right? We all knew this, is that the efficacy of these programs are getting less and less and less each time. In other words, it's taking more and more Federal Reserve interventions to generate a return out of the market. And at some point, the Federal Reserve is going to come to the table and say, hey, we're doing another $3 trillion of balance sheet expansion. And the market's going to go, don't care.
Right.
And because there's going to be this valuation point where, the markets start to reflect back what's happening in the actual economy. And, we're talking a lot right now about this V-shaped recovery. And this is what people don't understand. Yeah, we're going to have a V-shaped recovery or some type of recovery, right? We're going to recover. We always recover. But what people understand is that prior to 2008, the economy was growing at about 3.3% on an annual real inflation adjusted basis. After the 2008 financial crisis, we were growing about 2.2% because of the debts and the deficit increases and the fact we never allowed the system to cleanse itself. Coming out of this recession, we're currently estimating we're going to grow at 1.5 to 1.75%, well below what the Federal Reserve is currently estimating on economic growth, which is going to require bigger debts, more deficits, and which is going to continue to impede economic growth. And what that means is ultimately the argument from the perma-bulls is, well, the stock market's not the economy. True. Absolutely agree. The problem is the economy is where all those stocks derive their revenues from, their sales, their, what they're actually selling product to. And the weaker that economic growth gets, the weaker that revenue growth is going to be for these corporations. And eventually it doesn't matter. Valuations matter. And at some point down the road, there's going to be this realization and a reconnect between the markets and the economy. It happens every single time throughout history. And this time isn't going to be different. It's just going to be more painful.
Yeah, I'm really glad you underscored that, because that's something I think too many people are really missing right now, which has been the secular slowdown in growth overall. You talked about the slowing GDP. But if you look at the market gains over the past couple of years, particularly in the past year, it's really been all multiple expansion, right? Like when you look at the revenue growth of a lot of these companies, and let's take Apple, right? Probably the biggest, stock in the market right now. Its revenue growths have been pretty anemic over the past, several years, right? I hate to mention Tesla because there's so much wrapped up into that, but even Tesla's revenues have been, really pretty meager. Even though the stocks, was up over 10x in the, over the past 10 years, past year. So anyways, we do seem to be sort of on this collision course with reality, where as stocks keep powering higher, largely on margin expansion alone, and actual revenues and earnings continue to grow less and less and less, at some point, like you said, there's just a breaking point there where the math just can't support it anymore.
Well, yeah, exactly. I do a study about once a quarter on earnings, and if you take the cumulative revenue growth of the S&P 500 since 2009, cumulative revenue growth has been about 41%. Cumulative reported earnings per share growth has been about 300% because of all the stock buybacks, accounting gimmicks, write-offs, cookie jarring reserves, all these type of things. But at the end of the day, it all comes down to ultimately what you're generating at the top line, and you can only do so much at the bottom line. Now, one thing about this whole coronavirus recession shutdown thing, it's actually good for corporations' bottom lines, right? They're paying people less. They've got less employees to pay. They're paying less in rent, and commercial real estate's gonna have a lot of problems coming out of this whole issue.
Right.
But
unless you're an airline or a cruise ship, but yes.
Yeah. But for a lot of companies, they're actually going to have a little bit of a boost here at the bottom line, but that still is not going to offset the decline in sales that's going to occur by having 30, 40 million people unemployed. Right. And what we've gotten mistaken over the course of the last couple of months, and particularly with speculators, is that a lot of this rebound in retail sales and things that we saw was these $1,200 checks to households, $600 benefits. That's gone. We may get $300 here. We'll see. And the next, skinny bill. I'm very suspicious that we won't even get a bill passed now. Too close to the election. Nobody wants to be seen helping either party. So I suspect we won't even see a bill get passed. And that's going to really show up in these economic numbers coming forward over the course of the next few weeks. But, don't be mistaken. We were talking about social unrest earlier, and I've written a few articles about this. The social unrest is not a function of the headline cause of the social unrest. If the economy was firing on all cylinders, and if we didn't have a massive wage gap between the rich and the poor, and you didn't have a wealth gap where 10% of the economy owns 88% of the stock market, people would be generally happy. When people are generally happy, they're living their life. They're raising their family. They're going to school. They're going to work. They're not out in the streets rioting. These riots are a manifestation of the social wealth inequality that's been occurring in the economy over the last 12 years, primarily because of what the Fed's been doing.
So completely agree. We've actually talked about it at length on numerous videos before this one in previous weeks. We delved into it pretty deeply with Danielle DiMartino Booth, who you know, and she used to actually work as an advisor to the Fed, and right. she's right there with you and I, saying, hey, we should be grabbing our pitchforks at this point in time. And the sad part is I don't think that dynamic's going to change much until there becomes public awareness that the Fed really is the cause of the pain, as opposed to the hero and the defender of the public, which is obviously the way that it portrays itself right now. I think the better analogy is it portrays itself as the heroic firefighter showing up at the fire that it served as arsonist for, right? So,
exactly.
All right. Well, look, Lance, phenomenal job. Thank you so much for coming and sharing your insights with us today. You've done a great job, I think, of articulating some relatively difficult concepts for folks, but really, helping people keep them grounded as to, what the risks ahead are, at least. And we're not saying that the stock market couldn't recover from here for a bit, but, I think it's increasingly clear for folks that are looking at the data, particularly looking at the fundamentals like you've been talking about, things like margin debt and whatnot, that, there is a date with destiny out there. And so if you're going to be along this market, you need to have a plan B or an emergency exit plan for when things start going south, how you're going to get out. Or to your point, you've really got to be an active gardener, right? You can't just set it and forget it.
Well, I equate this a lot to sitting in a theater and somebody yells fire in the theater. The problem for the markets, and we saw this back in March, and it's probably more of a point than you wanted to make, but, back in March, the problem was the market crash was so fast that, we had 35% decline in a month. Never have seen that before. And that's equivalent to somebody yelling fire in a theater and everybody trying to get out the one door. So the thing that we telling our clients and things that we tell, kind of everybody is, hey, it's okay to be in the theater. Just sit closer to the exit, just in case, right? So if somebody yells fire, you're the first one out the door. The guy that doesn't make it out is the guy in the back, right? And so and that's what happens in this market. These things move so fast, you don't have a chance to exit. You've got to actually kind of exited prior to the correction like we saw this last week.
Thanks for underscoring that. That's one of the things we keep telling people too. And sort of like everybody thinks that, 85% of people think they're above an above average driver, right? I think about 80% of investors think, well, I'll be one of the first 5% out the door, right? And the math just doesn't work that way. To your point, you've really got to kind of be pre-exited before the big correction happens. All right. So Lance, as we let you go, I hate to do this because it's a little bit of a complicated question, but I think it's interesting and important for people to know. Before we let you go, if you could just spend a minute or two talking about SoftBank's role as the gamma whale. And sorry to give you such a complicated question.
In 2 minutes.
I'll give you 3 if you want it. But basically, folks, for watching, this is another thing that's been going on behind the scenes that has been sort of exacerbating the melt-up that we'd seen in the market over the past couple of weeks. And it's important to understand what was going on, particularly because it may not be going on anymore. And that may be being one of the reasons why markets are selling off here. So.
Yeah, well, so a couple of things in a nutshell. And again, it wasn't just one individual, as always is the case. There may be kind of the culprit individual, but then there's a lot of add-ons that happen. Very quick, just to explain the basics of options, because you have to kind of understand this one point to understand what happened relative to the market. If somebody's buying a call option, somebody else has to be writing that contract. An option is a contract between a buyer and a seller to execute some transaction at a future time and price. And it's a specified time and price. There is a specific date at which this contract comes to fruition. So when somebody buys a call option, somebody else had to write that call option. And this is a bet that stock prices are going to go higher. So when these prices start to go higher, the guy that wrote the contract has to buy the underlying stock in order to what they call delta hedge his risk. So these option writers are hedging themselves by buying the underlying stock as the prices move up. So this creates the more call options that are bought, the more ultimately, if prices keep rising, in the short term, the more buying they've got to do, which means that the call option buyers buy more of the call options because now they're making a bunch of money, so they want to do more of it. And this is all about leverage, right? We talked about margin. Margin debt is important because it adds leverage to my buying power. Option strategies in particular are a way to really leverage up your buying power in the market. So the more prices go up, the more options they buy, the more delta hedging has to be done. And this feeds itself until the point that it breaks. And so that's the basic analysis. What was happening is that SoftBank, who's made some horrible investments, are now trying to figure out a way to try to put some cash back on their bottom line. So they gave a guy they hired a bunch of capital and said, hey, go do a strategy. And so he was buying a lot of call options. He was driving the market prices higher. Well, he was just the initial catalyst that then spurred everybody else in the chain, hedge funds and retail investors and everybody else that saw the prices rising kind of in this melt up pattern to jump on and start doing the same thing. And you know that things are getting a little bit out of hand when you start seeing very young, inexperienced investors talking about discovering 3 times leveraged funds and what a great idea to make money this is. You're getting to the peak of this speculative endeavor. And that's what we saw happen. And it's just, we saw that go up. Now, is it over? It might be over for a week or two. But if prices do get back their feet, right, and prices start to go up again, it's hard to break momentum and it's hard to break bullish sentiment. And, this correction this week was painful for a lot of people, but it probably wasn't painful enough yet to pull out that bullish sentiment, that momentum chase that's been going on. And so they're likely to try to jump right back in and go, look, Tesla's cheap. I couldn't afford Tesla before, but I can really afford it now. So I'm going to go buy, because it's going to go back right back up to all-time highs. There's going to be a huge gain. This is the mental trap that investors get themselves into, is chasing this momentum, thinking it's always going to keep working out the same. But ultimately, it doesn't. And you start getting a bigger reversion in the process. And then once that happens and you start liquidating options, and then the other side of this happens and people start buying put options, then this is going to magnify itself to the downside. And so that's where, as I was talking about earlier, the risk of another downside correction through October, I think, is a really reasonable possibility. And I think it's something that investors should at least potentially hedge some for. Doesn't mean go be in cash and buy bullets and gold and ammo, but it does make a lot of sense to maybe have a little bit of extra cash. Think about adding some fixed income. We were buying bonds pretty heavily over the last couple of weeks on the 10-year treasury as a hedge for our portfolio. So, those type of things tend to work well in a decline. And don't forget about value. Value stocks have not performed with this market. The top 5 stocks have made up the same amount of gains as the bottom 394 stocks. So, on a market cap basis. So there's a lot of really good value-based stocks in here that we've added to our portfolio over the last couple of weeks. They're yielding 5, 6, 7%. And, the market was down 1 or 2%. And these stocks are basically holding flat or making gains. So it really limits the risk to your portfolio to have some out of favor type positions in your allocation as well.
All right. And I hate to ask this question, but you gave me the opportunity to ask it here, which is for folks that are positioned defensively right now and interested in the point that you just made about value stocks, and this is general, sentiment, general opinion. This is not personal financial advice. But would you recommend they consider, increasing their exposure to those value stocks now, or would you advise waiting until there's potential we're through the uncertainty of the next couple of months?
Well, first of all, that's kind of a hard question because you're talking about a basket, right? Value stocks in general. I would tell you this is that if I was a betting man with a long-term time horizon and didn't really care about anything else, I'd be buying every value stock I could buy, because for the first time since 1999, value stocks typically outperform growth stocks by about 4% on average. We now have a 10-year period where they've underperformed by almost 3%. That hasn't happened since 1999. And that was when, if you were buying value stocks back in 1999, it was like driving Dad's old Pontiac. Warren Buffett didn't know what he was doing at the time. And of course, he was proved right over the course of the next few years. And actually, from 2000 to 2008, value stocks outperformed growth stocks by a wide margin. So if I had time horizon, I'd buy value stocks all day long. Unfortunately, I have to make my clients money, and they won't stick around waiting for a value play to work. So I've got to do a little bit of momentum and blend in a little bit of value. If that's the type of thing you're looking at, you still have, and this is coming back to this, would you buy value stocks today? Answer is yes. Would I buy more value stocks today? Yes, but that doesn't mean you cannot risk manage those positions just as well. We have a position in ExxonMobil. We love the company value-wise. We think it's great. They're here in Houston. We know all about this company. We know what's going on. We're going to have to let them go here very shortly because they broke our stop loss barrier. We'll come back to it at a later date. But that's just proper risk management. Pull the weeds out of the garden when they're not working, and eventually we'll come back to it. Our other value positions are working great. They're holding up well. But if you buy a value, what we call a value trap, it looks like a value, but it's not. You got to let it go. So when it comes down to value, it's really about specific issues. But most importantly, when you're in an underperforming market like you are with value, you've really got to provide a risk management control to that and not just say, it's a value, I'm going to hold it forever.
All right. Great direction, Lance. I'm going to let you go. Thanks so much for giving us so much time and what I know has been a really busy week for you. As we let you go, for folks that are interested in following your work, where would you recommend they go follow you?
Easiest place to go is our website, realinvestmentadvice.com. And of course, follow us on Twitter at Lance Roberts.
Fantastic. And we'll put those up and overlays on the screen so folks easily know how to get there. Lance, Thanks so much, buddy. Look forward to having you on again.
Anytime. Thank you. Awesome.
All right. Well, Mike and John, Great as always, hearing from an expert like Lance. It's been a crazy week. We were talking at the end of the video last week. Was this going to be a one and done type of, sell off in the markets, or was this something that was going to have a little bit more legs? As we just talked about, with Lance, it actually has had a fair amount of legs so far. And today's action was interesting because we saw, a bounce yesterday, and as Lance said, that was a bounce off of the, I'm trying to remember which moving average it was. Maybe you guys remember. But today we've gone down and punched back through it. And so now the next resistance is going to be the 50-day moving average. And it'll be very interesting to see whether that still acts as support or whether we punch down through that. And if we do, it seems like, there's a lot of potential air below that for the markets to continue to fall further. Mike, why don't we start with you? We're finally beginning to get a little bit of the corrective juices coming into the market that we've been saying should be entering. We've been saying this now for months, basically. What's your attitude after watching what we've seen so far over the past week?
So the market over the last week, it has gotten a little more interesting. Finally, we're down about 100 S&P points as we talk versus when we did this video last Thursday, about 3%. Volatility has stayed pretty high, around 30 on the VIX. But, Lance did a really good job of laying the framework. This market has been defined by just rabid dip buying, and there's a sense that, well, this isn't really anything big yet. That's kind of the sense we're getting by looking at the news and talking to people. It's just kind of, the financial media doesn't really seem to think this is much of anything to worry about, that we're going to have a quick 10% correction and then it's a run right back into the election, which could happen. Who knows? What we can do is keep hammering home every week, the valuations. Valuations are off the charts. As Lance mentioned, forward PEs or one-year PEs back at 31 times. The way that we look at PEs over a 10-year kind of smooth basis, the so-called Shiller price-earnings ratio, further adjusted for other things like corporate profit margins as a percentage of S&P, they've never been higher. And they portend for negative returns over the next decade. So that's still the story. A little bit of a dip here, not enough of a dip to buy. We're down maybe, I think you said, 6% or so from the all-time high, not even a 10% quote-unquote correction yet. So as hard as it is, it's, we think that patience is still the right thing. I mean, I would say that our strategy is maybe a little bit different than what Lance was talking about there, being in the theater near the door in case it starts on fire. That is a viable strategy, and we certainly have tools to maybe help us do that, with put options and such. But, we think this market is such that it's probably not going to offer that type of opportunity. And we continue to do the same thing in terms of, being mostly net out of the stock market. We have some exposure to precious metal stocks, as we talk about every week, a little bit of emerging market stocks, and, a slight short position in the U.S. market, really to balance out the exposure in emerging markets. But we're net 0% or so. We're not short. We're not long. And we will look for better opportunities. We still don't think we see it here quite yet. We would expect this market to trade lower in the weeks ahead, though nobody knows the future. That's what we think is happening in the intermediate term, and we look for more of that.
Yeah, and so Lance talked about the importance of risk management. That's a huge reason why we started our relationship between Peak Prosperity and New Harbor, because of your guys' expertise and extreme focus on risk management. And it's served us and the clients very well. I'd say the number one thing that people ask us for help in when they approach us for a recommendation for a financial advisor is, how can you help me not lose money? How can you help me preserve capital? That's paramount to me. And then if I can get some prudent growth on top of that, great. But what I don't want to have happen is go into a 2008 style market correction, or even a February of this year market correction, and get caught flat footed and watch 30, 40, 50% of my portfolio just evaporate in a short period of time. And what I always value with you guys is when the market does go through a corrective event, at least in the times I can remember, you have delivered upon your value proposition to your clients, which is, hey, if the market goes down a lot, we've put defenses in place by portfolio positioning and using defensive options and whatnot to limit our downside risk. So we just talked about the S&P being down around 6.5% over the past week, the Nasdaq being down a little around 9%. How has the New Harbor portfolio performed, Mike?
We're about flat. We're down slightly, maybe 0.4% versus the high. Not a lot of change over that time, and we do want to caution people against focusing on short-term time frames. We're certainly not trying to data mine relative to the recent highs, but it should come as no surprise to the people watching these videos that New Harbor has a heavy cash position, that we're not net long the market, we're not net short the market, and a lot of our shorter-term fluctuations are dictated by what precious metal miners do. But so we are slightly down just because miners are down over that same period of time. Frankly, if the market went down 10% tomorrow, we would expect to be, relatively flat, or maybe even up a little bit if miners went up. We are really looking for, we're not all in cash, but we're really looking for the ability to tactically buy the market on more significant drops. Something more like 15-20% from the high. And we would almost certainly likely pair that with option trades, really to hedge that exposure. We want to be able to layer into the market in tranches over time, knowing that one of these times is not going to be buy the dip and go right back to normal like this one has been. This bounce from the March low, this return to normal, or the second wave bounce that we keep talking about, which we think is very well likely over. We want to be able to layer in. The perfect storm that this market has set up is this total complacency, the feeling that the Fed will always push the markets higher, never let them go down. Even the Speaker of the House recently said, markets can't go below a certain level. Nancy Pelosi said that. And, and that's okay. Well, we have kind of this institutional belief that the market has to be supported forever. The problem with that, at the most ridiculous overvalued situation ever in history, one of these times, buy the dip isn't going to work. And we have at New Harbor a strategy to layer in, hedge with options, layer in a little more, hedge with options. If the market goes flat or even down a little bit, we get to collect a premium, and we essentially can get more and more exposed to the market over time. It wouldn't surprise us at all to see this market drop 50% or more in the next couple of years. Easily could be done, and that would not even bring us to an undervalued situation. So you have to have a strategy of getting in over time, hopefully hedge with option selling or volatility selling, which brings income into the account. The people that are really going to get hurt, if we're right about what the market will do, are the people that buy all the way down and add more and don't have a plan. So I think that our strategy will shine during that time if we're right about what happens next.
All right, well said, and I think speaks very well to the conservative type of investor who really just wants to, preserve and not lose their wealth. And I hand it to you guys, both you and John, and the team at New Harbor, that in this latest, and again, you're right, it's a short-term period, so can't draw too many conclusions from it. But in the past week, with the S&P down, 6.5%, New Harbor's down, what you said, about 0.4 or so. That is a dramatically stark and impressive comparison versus the general market. John, I want to head over to you for a second here. I know before we hopped on here, you had brought forth a slide, kind of getting back to Lance's comments about overvaluation and market PEs, back up to historic highs of 31 times and whatnot. But I think you've got some data here that shows that the market may be more overvalued today than at any point in the past couple of centuries. Is that correct?
Yeah. So just a little, context. You asked Lance, kind of some textual questions about, are we in a bull or bear market? And I think he did a nice job at, pointing out that those are kind of terms that get thrown around with a lot of different, contexts, and, oftentimes miss really the bigger point. And in fact, in the kind of market that we are in now, and frankly have been for a long time, to use a word that Stan Druckenmiller tossed about pretty convincingly this last week. Stan, for those that aren't familiar with him, is a legendary investor, ran Duquesne Capital. Recently, kind of relayed his own humbling experience about in the tech bubble, even though he for years fought getting into that because he thought it was dangerously overvalued and just a bubble in the grandest sorts. He got sucked in at the very last moment. And just a parable how even the most risk-aware investors can get seduced into really dangerous things. And he throws that out. He lost $3 billion in just a matter of weeks by piling into tech stocks at the wrong moment. Anyways, he was out last week on the airwaves, mincing no words, basically saying we are absolutely in a mania type market. And when you're in that kind of market, bull and bear and all these kind of phrases lose all meaning in our opinion. And in fact, it comes back to the valuations that, both Lance and Mike just touched upon. If you want to talk really about bear and bull markets, you got to look at where valuations end up going. And these are things that these markets we're talking about are usually decade or longer in duration, not, over a span of 6 months. And we should be talking about which is which. And reliably, you can go back to every bear market. I mean, truly bear markets, the housing bubble, the tech bubble, and the bear markets before then. And valuations don't stop where they are now. They stop at Shiller PEs at 15 or lower. Even in 82, they got down to like high single digits. So if you really measure, bear markets on valuations, all this has been noise. It's even, kind of comical to even talk about those terms, frankly, in the kind of mania market we are right now. But back to the chart that I shared in your reference. What this chart is, it's a chart that goes back, quite some time. In fact, this goes back to the 1860s. It was pulled together by Deutsche Bank. And what it shows here is the kind of valuation extremes for a mix of stocks and bonds over 15 different developed market economies, going back this time frame. So it takes the average of those measures, the percentiles of the valuation. So if you look at any one country, if the percentile was at 100%, it basically means there's never been a point in history where stocks in that country were more overvalued relative to GDP, okay? So this looks at a mix of both stocks and bonds and averages it over those 15 developed countries. You can see here, never before have we, had the combination of stocks and bonds being more overvalued than they are right now. And this goes back to 1860. The quick takeaway, and you can see if you look at the rightmost pane of that chart, the last, ever since the bear market low of 82 through right now, of course, we had some big pullbacks along the way, but we've had a period of time which, in no small part because of declining interest rates and debt expansion and stuff like that, both stocks and bonds have, risen dramatically. But they've reached this point where they've never been a bigger bubble, both stocks and bonds. And frankly, there's never been a point in history where both stocks and bonds have been as egregiously overpriced and unlikely to give upside potential than they are right now. So the humbling takeaway here for folks, most investment assets, stocks and bonds are horribly priced right now. Unless you're betting on, over a century and a half here or so of history no longer being a tethering point. And that really gets to the point of, when manias here as shockingly as the restraints get blown away and markets go to yet higher highs, the same we have found when things ultimately turn, and we don't know exactly when that is. We don't know if this recent pullback is the start of a big turn. But when that turn happens, in the same way that the upside restraints get recklessly abandoned, so too do the downside supports. And that's the death spiral where people get sucked into not only holding on because they think things are going to bounce, but they end up buying more, and they end up buying the whole way down. That's what happens when you get in mania markets that have, egregious valuations like we have right now.
All right. Thanks, John. That's great perspective and a great way to end today's call. Perched on the verge of, where this current correction is. I can't really call it not a bear market like you guys said.
It's a pullback anyway.
Yeah. But geez, after, nothing but relentless month after month after month of stocks going up, this does feel like a big major event, even though it's basically been 4 down days in the market that we're talking about. But it's going to be very interesting to see where things go from here, because it does seem like we're pretty much getting close to the line in the sand for this market, whether it's going to be able to prove resilient and bounce back up to previous highs and then perhaps above, or whether we're going to punch through some of these key support lines that we and Lance were talking about. And if that's true, then we really may start seeing, some of the reckoning that we're saying needs to happen at some point in this market coming along. And as Lance said, there's a lot of uncertainty coming up, folks, to drive prices to the downside, whether that's the uncertainty around the election, whether that's the fight in Congress right now over the additional stimulus checks. And if those don't go out, given the damage that the real economy has taken, as Lance said, you're going to start seeing that take its toll inside the stock market pretty soon. So anyways, we will be watching these closely as we say, that's our commitment to you, the viewer, week after week, is we will be watching what happens on a day-to-day basis and then summarizing it for you at the end of the week in these videos. All right, Mike, with that said, anything, I'll let you have the last word as we clock off here since we're at the end of our time. Any general advice to the concerned viewer here that hasn't been mentioned yet in the program?
I think we'd reiterate, our past guidance that this is not a return to normal. Think about reducing your equity exposure down to below 30%, 30% or below. If you're not with us, I told you earlier that we're net out of the stock market. If you're self-directed, go in there and reduce your stock market exposure to 30% or below. The only investments that make sense right now are probably real assets, gold and silver. If you don't have any, think about getting some. Silver was really ridiculously undervalued versus gold. It's more normalized now, so we're more ambivalent about which you buy, gold or silver. And I guess I wanted to mention one more thing that Lance mentioned earlier: value stocks. They've been doing really bad for a long, long time. He mentioned ExxonMobil. It's down at 37. It probably will go lower. The whole oil and gas sector will probably go lower if the S&P goes lower. But value stocks could look attractive to us. Probably not here, but certainly if the S&P takes another tumble, we'll be looking hard at some of those value sectors. They're just completely, they've been dogs. People haven't wanted them. Oil and gas looks good. I guess I'd like to reiterate that as well as a potential idea that we're looking at. Other than that, we'll just keep our eyes open for something interesting to talk about next week.
All right. And with that, guys, we'll clock off here. If you're watching and you would like to talk to a financial advisor that understands the risks that we talked about in today's program, both Lance and the guys here at New Harbor talked an awful lot about risk mitigation. That's something that a lot of individual investors don't really know how to do very well on their own. So anyways, if you'd like to talk to the good folks here at New Harbor, stick around to the end of this video. We give you instructions on how you can basically get a free consultation with them. It costs you nothing. There's no obligation to work with them. It's literally just a public service that Peak Prosperity and New Harbor have worked out together because we want to help people preserve capital. So if that's of interest to you, Mike, John, as you guys are speaking in this video, I'll make sure that we put up the Greylock Peak URL on the screen like we do every week. And then anybody who wants to talk to you guys can just go there, fill out the quick form, and you guys will be in touch with them. All right, guys, with that said, thanks so much for coming on for yet another week. It is interesting that we finally have some, different than what we've been seeing market action to react to. And, as Lance was saying, the elements that we're having to watch here are beginning to come fast and furious now. Look forward to watching them with you guys this week, and then reporting back to folks next week what we think is most likely to happen next. So enjoy your post-Labor Day return back into the working world, guys, and we'll see you in a week.
Thanks, Adam. Good to see you again. Talk to you next week.
Thank you, Adam. Talk to you next week.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA, but for regulatory reasons, they aren't able to take on non-US clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.